Hello everyone, I am Disha. Welcome to Drishti IAS. So in today's video, we will be talking about recently released Financial Stability Report 2026. First of all, we will talk about the static portion, what actually Financial Stability Report is. Then we will talk about its objective. And at last, we will see the key highlights. And of course, a practice question for all of you. So without wasting time, let's get started. Okay. Uh, First of all, I would like to ask you a question. The question is why financial stability is important? Why do we emphasize on financial stability? Why do we need to be financially stable? I'm talking about obviously at a country level. Why does financial stability is important? I want you to answer this question in the comment box, okay? But if I have to tell you that why financial stability is important, the core reason is because it creates a trust in the people. If people believe that our country's economy is stable, if we are financially stable, then the people keep trusting on the banks. They will keep investing in the banks. They will keep depositing their money. Similarly, the foreign investors, if they will believe that the India's or a country is financially, if the country is financially stable, then they will keep investing in our country. We will receive foreign direct investment, okay? Because we have continued to develop that trust. So this is very obvious that financial stability is extremely important for any country, not just for India. That's why RBI releases the Financial Stability Report. RBI has to make sure that we are financially stable. So in this particular report, we see that what are the vulnerabilities, what are the challenges which can hamper our stability. Okay, that's why we are reading this report. So let's start. Okay, first fact which you have to remember is that Financial Stability Report is a biannual report. That means it is released twice a year. Okay, it is released twice a year. In the gap of every 6 months, it gets released. RBI releases it. Okay, Reserve Bank of India is the one who releases the Financial Stability Report. This is the first fact, important for your preliminary examination. Okay, now in 2010 March, RBI published the very first Financial Stability Report. The very first Financial Stability Report was published in 2010, okay? And since 2010, RBI has been publishing it after every 6 months, okay? Now, the Financial Stability Report is prepared using the discussions and findings of the subcommittee of the Financial Stability and Development Council, that is FSDC. Now, does the RBI prepares this report alone? The answer is no. RBI do take the help of different committees, okay? Now, see. Financial Stability and Development Council, okay, we will read this in the next point itself, but there is a subcommittee which comes under the Financial Stability and Development Council. It is this subcommittee which does the analysis and discussions with the RBI and helps RBI to prepare this report, okay. So it is this subcommittee which comes under the Financial Stability and Development Council, which is your FSDC, which helps RBI to prepare this report. Am I clear with that? Okay. Now, let us talk about the Financial Stability and Development Council, which is your FSDC. FSDC was set up in 2010 to help to keep India's financial system safe and stable. FSDC was created to make sure that our country's financial system is stable enough. Okay. Now, if we talk about financial system, if I talk about financial system, what does it include? Entire system has many components. We have banks, we have NBFCs, we have share market. All of that comes under your financial system. Okay. So FSDC was created in 2010. Can you see the similarity? See, FSDC was set up in 2010 and the report has also started to get released in 2010 itself. Okay. It's a non-statutory body. FSDC is your non-statutory body. Now, what does non-statutory body means? It was made just by an executive order of the parliament. No act was passed to create FSDC. Okay, it was created just by an executive order of the government. Now I want you to tell me in the comment section what are the other non-statutory bodies which has been created by the government just by giving an executive order. Okay, do let me know. So FSDC is a non-statutory body. In which ministry, under which ministry does it comes? It comes under your Ministry of Finance. Okay, it comes under your Ministry of Finance and it is headed by the Union Finance Minister. So let us recall the facts which we have talked about. Okay, the first fact is Financial Stability Report is a biannual report. It is released by the RBI. The first report was released in 2010. Okay. Financial Stability and Development Council was set up in 2010. It comes under the Ministry of Finance and it is chaired by the Union Finance Minister. Okay. We have talked about the basics. Now let us talk about the objectives. What are the key objectives of this report? Okay. Now, these are the objectives. Let us read them one by one. Now, the first objective of this report is to assess the vulnerabilities in the banking and financial sector. Okay. Now, the RBI checks, is there any vulnerability in our financial system? Vulnerability means what? What? It means weak areas. Weak areas or any sort of a problem which has the potential to become a crisis in near future. Okay. So what does RBI do? RBI assess that if there is any vulnerability in our financial system. Okay. For example, if RBI observes that banks are lending too much money to the risky borrowers, they are lending money to the risky borrowers, then that is a problem. It has a potential to become a crisis in near future. So what RBI will do? RBI will check if there is any vulnerability or weak area which exists in our economy, and accordingly we will work on that. Okay. So the first point is we will assess the vulnerability. Second is we will monitor the systematic risk. Now what systematic risk means? Systematic risk means any risk which can affect the entire system. Okay, that's why it's a systematic risk. This risk has the potential to affect the entire system. For example, if any large bank fails, it can impact the other small banks as well. It can erode the people's trust. So it is a systematic risk. RBI will monitor the systematic risk. Okay. Now the third point is it will assess the resilience and soundness of India's financial system. Okay. We will see whether we are resilient enough or not. Now what does the word resilience means? Resilience means the ability to recover from shocks. Oftentimes we face problems in our life. Okay. If I talk about an UPSC aspirant, a UPSC aspirant should also remain resilient in their preparation. Okay, because we do face a lot of problems in our life, but despite of all the setbacks, doesn't matter if you're failing in different exams, we have to keep prepare. We have to keep our preparation in a right direction. Okay, and if you are able to do that, that means you are resilient enough. So RBI believes that our financial system should be resilient enough. That means if any economic crisis comes, we should be resilient enough, strong enough to recover from that crisis. Okay. Next objective is it evaluates the potential in domestic global risk to the financial stability. We will also evaluate if there is any potential domestic or global risk. Okay, because if we are able to evaluate that, if we are able to predict that, then we will be better prepared for the crisis, right? Next, it supports the informed policy making and microfinancial stability. Okay, it will help the policy makers to make the better policies. So these are the key objectives of Financial Stability Report, and you have to keep them in your mind. I'm not asking you to learn all these points, but you should have the broader idea, because in your preliminary examination, oftentimes they ask you about the objectives. Okay. Now let us see the key highlights. Okay, what are the findings of RBI's Financial Stability Report? The first finding is that our Indian financial system remains resilient. Okay, this is a very good point. Our financial system has been able to remain resilient. This is what RBI has observed. Why we are able to remain resilient? Let us see. RBI has observed that India's economy and financial system have remained resilient despite significant external shocks. We have faced many external shocks. There were geopolitical conflicts. In 2025, we had a conflict with Pakistan. Recently only we saw that there was a conflict between US and Iran. In some way or the other way, it impacted our economy. Okay, the LPG prices got increased. Our rupee got appreciated. But still, despite of all those external shocks, we have been able to remain resilient. And why we are able to remain resilient? Because there is a strong economic growth. Okay, our GDP is growing steadily. Moderating inflation. Inflation is there, but it is in moderate range. That is between 2 to 6%. Okay, if inflation is between 2 to 6%, then we will consider it as a moderate inflation. A moderate inflation is always considered good for the economy. Why I am saying this? Because see, if inflation is there, what it indicates? It indicates that there is a demand in our economy. People are buying goods and services. And a strong demand always indicates better economic growth. Because see, what will happen is that if there is a demand, then there will be more production, because in order to match the demand, we need to match the supply as well. Okay? In order to match the demand, we will do the more production. If we will increase our production, then in that process, more employment opportunities will be created. Okay? And that will increase the people's income, and they will continue to spend even more. It will also increase our investments. That's why a moderate category of inflation is considered good for our economy. Okay? Healthy balance sheets of the financial and non-financial institution. Healthy balance sheet means what? That assets are greater than liabilities. Our liabilities are less and our assets are more. So this is also a good indicator. Then we have the adequate capital and liquidity buffers. What RBI has observed is that our banks have enough liquidity buffers. Liquidity buffers are just like your emergency fund. Okay, if there is any crisis or if there is any situation of emergency, in that case, banks have enough liquidity buffers to deal with that crisis. So because of all these reasons, we have been able to remain resilient. Okay, this is your first point. Now the second point is banking sector continues to strengthen. Again, it is also a positive point. Our banking sector is becoming more stronger. Okay, why I am saying that? There is a reason. See, the gross non-performing asset, that is GNPA ratio, declined by 1.8%, the lowest level in several decades. Now to understand this point, we need to know the concept of non-performing assets. What are non-performing assets? See, there are two primary objectives of a bank. The first objective is to accept deposits from us. You go to the bank and you give them that particular amount, and you say this to bank that I am depositing my money to you. So the bank has the primary role to accept deposit. The second objective is to lend money, okay, or to provide loans to the people. Now always remember, for a bank, a loan is always considered as an asset. Okay, for a bank, loan is always an asset. For us, it is a liability because we have to repay that loan in future. So it's a burden on us. But for a bank, it is always an asset. Okay. Now, there is a condition when this loan is converted into non-performing asset. It is an asset, but it is a non-performing. It's a bad asset. In which condition the loan will turn into non-performing asset? There is a condition. The condition is if the borrower has failed to repay its principal or interest amount for more than 90 days. 90 days have been passed, but the borrower has not paid the principal amount or interest, you can say. In that category, the loan, that means the good asset, will be converted into non-performing asset. Okay, and that is your gross non-performing asset ratio. Now, what this says, that the gross non-performing asset ratio has declined by 1.8%. That means these non-performing assets, NPA is reducing, okay, which is a good sign. That means banks have healthy assets as compared to bad assets, okay. The lowest level in the several decades. Improvement in the asset quality was observed across all categories of banks. Annual slippage ratio declined to 1.2%. Now our slippage ratio has also declined. Slippage ratio means what? When good loans are slipped into the category of bad loans. Okay, let's just say in year 2022, out of 100 borrowers, 90 borrowers were repaying their loans on time. Okay, in 2022, out of 100 people, 90 people were repaying their loans on time. In 2022, 90 people were repaying their loan on time. But in 2023, only 40 people are repaying their loan on time. That means the 50 people who were in the good category in 2022, they have slipped into the category of bad loans. So the slipped ratio has also declined. Okay, it has come up to 1.2%, indicating the fewer standard loans turning into NPAs. Okay, are you able to understand these points? Shall we move forward? Now, the report also observes that there is a rise in global risk. The report identifies the following emerging threats to the global financial stability. There are some emerging threats which can risk our financial stability. What are those threats? Let us understand that. Okay. Increasing geopolitical conflict. Now that we have already observed that the geopolitical conflicts are increasing. Okay. Rapid technological disruption driven by artificial intelligence. Now what does this report says? This report says that AI has increased the efficiency of jobs. AI has some merits as well and some demerits as well. Okay. The first merit is that it has increased our efficiency, but at the same time, it has led to the disruption as well. Okay. We have new set of problems which has emerged due to AI. New set of problems have emerged because of an AI. What are those new set of problems? We have data leakage issue, data privacy. There is a job loss in the market because of the AI, because it has been said that AI will increase our unemployment rate at some point of a time. It will eat up the traditional job roles. Okay, so it can become an emerging threat. Persistent inflation in advanced economies leading to the tighter monetary policy. Now the report also says that there has been a persistent inflation in the advanced economies like US. Okay, now how it will impact our economy, let us understand that. You must be aware of the fact that if there is a persistent inflation in any country, the central bank of that particular country will adopt a tighter monetary policy. Now, in that approach, the central bank will increase the interest rate so that borrowing can become expensive. Okay, similar thing will happen in the US. The bank will adopt the tighter monetary policy and the interest rates will be increased. Now, how it will impact India? See, there will be foreign investors who have deposited their money in the Indian banks, or they have invested in the Indian bonds. When they will see that the US is offering a higher interest rate, they will withdraw their money from our financial system and they will go and deposit their money to the US banks. Okay, this will result in the rupee depreciation. So that's how the persistent inflation in advanced economies can affect us. Okay, it can become an emerging threat. Then the rising public debt levels. Government is borrowing too much to spend. Okay, it can create a fiscal imbalance and it can become an emerging threat. Then the growing leverage among the non-bank financial institutions. Okay, now what does this word leverage means? Leverage means when you borrow money to invest in other, when you borrow money for the investment purpose, or when you're borrowing money to lend others. Okay, so this is the leverage, and your leverage ratio should be on a lower side only. If it gets higher, then it can become an emerging threat. Okay. Then the sector-wise asset quality assessment. Asset quality has improved across most sectors of the economy. Okay. Now, this is an important point. See, agriculture continued to record the highest GNPA ratio at 5.1%. This is a very important point for all of you. Okay. You can use this point in your mains answer writing. If in GS paper 3, if a question comes, let's just say that give some points about the rural distress or discuss about the issues which agriculture sector is facing. So in that question, you can mention this point that agriculture continue to record the highest gross non-performing assets ratio at 5.1%. That means farmers are not able to repay their loans on time. Okay, you can also link it with the current El Nino situation going on. We have read that El Nino is going to impact the agriculture, okay, because this year there will be less rainfall. So again, agriculture accounts for 37.2% of the total number of GNPAs of the scheduled commercial banks. Okay, 37.2% of the GNPAs. If we talk about the total non-performing assets, out of 100, 37 comes from agriculture sector only. That means we need to work on this particular sector. Okay. So these 2 points are important for you. You can use this in your answer writing. Okay. So these were the key highlights. All right. Now let us solve some questions. Okay. So that I can know that you have gained clarity. Okay. Question 1 is the primary objective of Financial Stability Report. What is the primary objective of FSB? Option A, recommend the union budget. Option B, assess the risk and resilience of the financial system. Option C, fix the lending rates of commercial banks. Option D, regulate the foreign exchange reserves. You have to choose the correct option. You can pause the video and write your answer in the comment box. Okay. Alright, so the correct answer is option B. The primary objective of Financial Stability Report is to assess the risk and resilience. This is the most accurate option. Okay. Now, next question. A loan is generally classified as non-performing asset when? Option A, the borrower defaults for 30 days. Option B, the borrower defaults for 60 days. Option C, interest or principal remains overdue for more than 90 days. Option D, the borrower misses one EMI. Okay, again pause the video and write your answers in the comment box. Alright, so the correct option is option C. When interest or principal remains overdue for more than 90 days. Okay, you have to remember this data. If your interest or principal remains overdue for more than 90 days, 90 days have been passed and you have not returned your principal amount to the bank, then your loan will be classified under this category, which is non-performing assets. Okay, I hope you are able to understand the key highlights, and thank you so much for watching.
For more informative content, like, share and subscribe, and do not forget to press the bell icon to get the notifications.